Good evening, everyone. Tonight, Sensible Money's founder and CEO, Dana Anspaugh, will talk us through how to make a retirement income plan. Dana, as all of you on this webinar know, is one of the nation's leading authorities on retirement planning and retirement decumulation. She's the author of Control Your Retirement Destiny, which you can also find as a podcast on Apple, Spotify, and iTunes. And you'll find her popular online course, How to Plan for the Perfect Retirement, available at thegreatcourses.com and at wondrium.com. In August of last year, Inc. 5000 recognized Sensible Money as one of the 5,000 fastest growing privately owned companies in the country. All of us here recognize it every day as a great place to work. I'm Nancy Fellinger. I'm one of the financial planners here at Sensible Money, and I'm in Pawleys Island, South Carolina. Most of the rest of the team is based in Scottsdale, Arizona, but we also have team members in Massachusetts, Florida, Oregon, Indiana, and South Dakota. Using some of the same technology that we're using tonight, we can work seamlessly with each other and with our clients all across the country every day. So with that, Dana, let's get started.
Thank you so much, Nancy. Well, before I get started tonight, I am going to kick off with the disclosures. For those of you in the financial services industry or who have attended other events, you know that our industry is really big on disclosures. So we will be going through some examples and some case studies tonight, and we need to let you know that, of course, nothing is a guarantee. We use samples, but every portfolio and every plan is customized to each client. So one person's experience can be vastly different from another person's experience, depending on all kinds of circumstances. None of the charts that we're showing are meant to imply the performance of any type of portfolio. We are not doing anything that's supposed to be intended to represent the solicitation of a security or the offer to provide investment advice. So, that being said, I appreciate you all taking your time to join us on a Thursday evening and learn about how to make a retirement income plan. One of the most frequently Googled phrases is how much to retire, can I retire, how much do I need to retire? It's a very difficult question to answer because it depends on all kinds of variables. What age do you want to retire? Somebody who is going to retire in their early 50s has a far longer time frame to plan for than someone who might work till their early 70s. That affects, of course, the number of years that you'll be in retirement. Living off your money for 15 years is far different than living off your money for 40 years. What's your desired lifestyle? We have clients that take out as little as $1,000 a month from their portfolios. And we have clients that take out, gosh, I think our largest client, over $40,000 a month is what their retirement paycheck is. So your desired lifestyle, of course, has a big impact on how much do you need to retire. Do you own a home? Do you still have a mortgage? Do you have access to health care through an employer? Or if you're retiring early, will you need to pay for your own health insurance for several years before Medicare begins? And your health impacts things. Better health typically means lower healthcare costs, not only throughout life, but of course also in retirement. So how do you begin to put all of this together and actually answer the question of how much do I need and can I afford to retire? And that's what we're going to walk you through tonight, is the process that we use. We consider this a best practice process of laying out a retirement income plan. Where we start is with projecting out true income from sources other than the portfolio. Maybe it's part-time work, maybe it's an annuity payout, it could be rental income, it could be Social Security, it could be a pension. And we want to know, where is your income coming from? Well, while you're working, of course, it comes from your paycheck. It's pretty easy, right? And we can go through a pay stub and we can see, all right, well, there's certain withholdings, federal income tax, Social Security, you're not going to be paying into that in retirement. Maybe contributions to a 401k plan. Well, you wouldn't still be contributing to that in retirement. There's no health care premiums on this paycheck, but sometimes your employer is paying for all of your health care, and so you may have to pick up that cost after retirement. So is your year-to-date pay a good proxy for what you're going to need in retirement? Not always. We look at that as a starting place, of course, but it's not always a great estimate of what you'll actually need in retirement. But oftentimes, as in the example that we're going to look at tonight, one spouse may retire, there may be an age difference, and another may continue to work. And so in that case, we're pulling all of the data from the pay stub to project the earned income of the spouse that is still working. And we have Social Security. Widows and widowers can actually claim a survivor benefit as early as age 60, but they will take a decreased benefit for claiming early. You can claim your own retirement benefit as early as age 62, but you will take a decreased benefit amount for claiming early before what is called your full retirement age. That is a technical term defined by the Social Security Administration, and it varies based on your year of birth. Then, as we show here, your full retirement age for everyone we're talking to today lands between age 66 and 67. And so if you claim before that age, you will get a decreased benefit. And if you claim before that age and continue to work, there is something called the earnings limit that you can bump up against. And so they may withhold some of your Social Security benefits if you earn too much. Now, the magic thing about the full retirement age is after that age, you could claim Social Security and continue to work with no decrease based on the earnings limit. They would not dock your Social Security benefits because you were earning income after full retirement age. Regardless of your age, you will pay taxes on your Social Security benefits. Some of you who have lower income or not a lot of sources of income outside of Social Security will only pay taxes on, well, actually, you might not pay taxes at all. I shouldn't say everyone is going to pay taxes on Social Security because not everyone does. If your income is low enough, you actually would receive your Social Security benefits tax-free. All of you receive 15% of your benefits tax-free. Some of you will pay taxes on up to 85% of your benefits. That's a very difficult question to answer also because we have to project out all the sources of income that you'll have, run it through the tax formula to determine each year in retirement what portion of your Social Security will be subject to taxation. And then age 70 is currently where you get maximum benefits. There is no benefit to waiting past age 70 to claim. And most of the time when we're working with couples, it makes sense for the highest earning spouse, the one that will have the largest age 70 benefit, to wait until 70 because that becomes a survivor benefit for either spouse that is the longest to live. Now, since we're on the topic of Social Security, I will say, I had a client email me their Social Security statement. Was it at the beginning of this week, I believe? They are late 60s, about 68, and their plan was to wait till 70 for the husband to file. And so his question was, Social Security statement was basically showing the exact same benefit, whether he claimed at 69 or 69 and 4 months or 68. I can't remember the exact ages. And it was also showing a certain survivor benefit for his wife based on their full retirement age. Now, they are both past full retirement age. My response to him was that his statement was dangerously wrong. Like, it was so misleading. I understand what they were doing, but it was so misleading that if people were looking at that and not educated about the terms full retirement age and not understanding that you do get an increase for every month, it's a monthly calculation when you claim benefits, people are going to make really poor decisions by simply looking at that data. So it got me fired up. If you can't tell, I got a little fired up about it because lots of people don't reach out to advisors, and so they are making decisions based on that information. So be cautious. That's my warning. Unless you feel like you thoroughly understand what's on that Social Security statement, it is entirely possible that you are misinterpreting it. The other factor that wasn't on the statement was the impact of inflation adjustments. Social Security benefits went up by over 8% this year. Even if you're delaying the start of your benefits, that increase will apply to your benefits in the future. So there's all kinds of reasons that for many households, it makes sense for the highest earner to delay. All of that being said, let's dive in and look at a case study. We are looking at a fictitious couple. They are a composite of many of our clients. We will call them James and Sandy. And we are starting off with what we call their income timeline. So this is cash flow coming not from their savings and investments or retirement accounts. And I'm going to see if I can blow this up a little bit. I can. What we see is at the top is a calendar year, and we have their age. Oh, and it won't let me use the laser pointer and blow it up. So at the top, we have their age at year end. And James is retired. This is his first year of retirement. He is 66 at year end, but his wife, Sandy, is still working. Sandy's 61, and we can scroll forward and see that Sandy plans to work until 65. Now, we have James and Sandy's Social Security projected, and we see out here that James would be claiming at 70, and Sandy might get a partial benefit the year she turns 65. I don't know their exact claiming strategy without pulling up the report, but we can see out here she's getting a full year's benefit starting in 66, at her age 66. And then there's a small pension. So there's a pension age 65. I believe it belongs to James. And so that would be, no, it must belong to Sandy because it's starting at age 65. So my guess is that would belong to her. So once we get out here at 70, 72 for James, they're going to have about 89 to 93,000. Social Security's inflation adjusted. We're using a 2% increase in our projections. We're going to have a guaranteed source of income coming in. So that looks pretty good, but they need more than that. They need more cash flow than that. How do I know they need more cash flow than that? Well, that comes from their expense timeline. Rather than looking at their take-home pay from their pay stubs, we do what we call a bottom-up analysis. So we ask people to itemize all of their expenses in retirement. And that can involve looking at both your credit card. Some people, like I put all my spending on a credit card. I like to get the points. I pay it off in full every month. But there's some things that are recurring. Many people have their utility bills, cable, cell phone set up to just simply debit out of their bank account. So you have to account for those things. There's non-monthly recurring items you have to take into account. Those might be things like auto registrations that come up once a year. It could be insurance premiums. Many people pay those every 6 months or once a year. It could be your property taxes that you may write a check for those once or twice a year. It could be dental expenses. It could be something for your children, some kind of renewal or club membership. So you have to account for the non-monthly recurring items because those will continue. And then there's things people forget. Those often entail home repairs. You will still have those in retirement. So we'll often ask people if there's any major home repairs coming up. A roof, does the whole house need new flooring? Some smaller things like a furnace may not have as big of an impact, but a roof or needing to redo the plumbing or the electrical if it's an old home, those things will certainly have an impact and be bigger expenses. And there's smaller things like dental expenses. Sometimes people forget to put those in. I have 8 crowns, and so I always think about dental expenses when I'm planning budgetary. I always know in any given year I could have several $1,000s of dental expenses. So we like to itemize all of that out and come up with a projection. One of the things that we will add into the projection are healthcare estimates based on the phase that people are at. So there's 3 distinct phases. There's pre-age 65, where you're often buying a plan off of the exchange, healthcare.gov, or if you're lucky, you will have coverage that's offered through an employer, pre-retiree coverage. There's post-65, where you are on Medicare and usually have a supplement plan or a Medicare Advantage plan. For most of our clients, we're seeing they are buying a Plan G supplement. And then there's the tail end of retirement, your later years, where long-term care costs can come in. And those can vary. Some people need no long-term care. Some people just need help around the house. It might be now they need help with cleaning, cooking, and other people will need to be in a facility with full care. When you're estimating those costs, this is data that comes from a Vanguard Mercer report. We do have the link. You can search for, Vanguard Planning for Healthcare Costs in Retirement and find it online. And they updated the report just, I believe it was 2021. So these numbers are about 2 years outdated. But this was the pre-age 65 estimate, where if you were looking at somebody with a medium risk, now we didn't put low risk on here, and I'll explain why in a minute, but if you were looking at someone that was classified as medium risk, the risk categories have to do with things like high blood pressure, certain medications that you're on, if you had, in your past, if you had heart conditions or cancer, things like that. Diabetes would put you on this medium risk or even high risk category. If you are categorized as medium or higher risk, your cost estimates are going to be a little higher, more out of pocket, more prescription costs each year than someone in the low risk category. So here what we're looking at for what's called the silver plan would be about $8,000 a year in premiums and about $4,800 a year of out-of-pocket costs for a total of about $12,800 a month. Now, depending on your age and which plan you choose, we're seeing people pay as much as $1,000 a month for their premiums. Mostly, we see these estimates come in fairly accurate. There's a bronze plan. The coverage would be slightly different, thus the premium is lower, but the out-of-pocket cost would be expected to be higher. And the reason we see, if you're lucky enough to have employer coverage, this was an estimate for someone age 64, the premiums were estimated at $4,200 and out-of-pocket at only $1,300. You can see that the costs go up for someone in the higher risk category. It's not the premium costs that change, it's the estimate of what they may be spending on out-of-pocket. So we're typically budgeting for someone that has to buy a plan off the marketplace, off the healthcare.gov, about $1,000 a month if they're buying their own plan in that gap range. They may retire late 50s or early 60s and not be starting on Medicare, of course, till 65. Then you have the second phase, post age 65. And here's where you have traditional Medicare. There is no longer Plan F, so this report from is a few years old. The Plan G has primarily replaced Plan F. And so the cost estimates are still going to be similar. So you have, again, medium risk. Wow, substantially lower costs than what you saw in that pre-65 phase. And so we build this into our projections. Typically, people are going to pay more, and once they go on to Medicare, their total out-of-pocket costs, including their premiums and pharmaceuticals and everything, are going to be lower. Then you can see, as you add on, if this was only Medicare, if you add on a supplemental plan, most people who can afford to do so, they will want to do that, and it will cap their annual out-of-pocket costs. So we see the premium went from about $1,800, which would be an estimate of just your Part B premiums. So Medicare is not entirely free. Part A is free, but there is a Part B, and you do pay premiums for that. And those premiums are means tested, meaning they look at your tax return 2 years prior. If your income exceeds certain threshold amounts, you will pay a higher premium, and that is reset every year. So some people think once you are subject to those higher premiums, it's permanent. It is not. It's reset every year. And there's some reasons you can request a reconsideration for those. So if your income was higher 2 years ago, but this is the first year you're retired, you can say, hey, those higher premiums, those don't apply to me. I'm retired now. And so there is a process there where you can appeal. But you do see this $1,800 would be an estimate of the basic Part B non-means tested premium. And then if you were add a supplement plan on, the premiums went up to $3,600. And this is about what we're seeing. We are seeing people pay about $200 to $350 a month for their supplemental plans in retirement. But on top of that, they're paying their Part B premiums. The numbers are a little higher because this data is a few years old. So when we add inflation on that, the numbers go up a little bit. This is how you start to account for that in your budget for retirement. When we put all of this together, we create a timeline. And so again, we have James and Sandy, and theirs is a very detailed timeline. And expenses and taxes is what we're solving for. So I'm going to blow this up. And we see here, we're using a 3% inflation rate on most of their items, but they have a mortgage. And we itemize the principal and interest part of the mortgage separately because it's not going to inflate. And a matter of fact, it will be paid off partway through retirement. But their taxes and insurance, those will have inflation. And so we have those budgeted and they are going up each year by an estimated 3%. We have a separate line item for home upkeep and repairs. This is a little larger than what we normally see. So likely in our composite, they have a slightly older home or they're estimating they're going to need to put some more work into it in the next few years. We have their basic living expenses. Those are lower than a lot of estimates, but that's because here we've itemized everything out. That would typically cover your utilities and cell phone and gym memberships and household expenses. They have their auto expenses itemized separately and their auto insurance and auto maintenance itemized separately. We typically don't get that detailed or granular in these estimates, but some people want to get that granular. And then we have travel and vacation, and we intentionally did not inflate that. So that just reflects that they'll be spending a little bit less on travel each year, and that's pretty common. People in their go-go years and early retirement often travel more and spend more. And so rather than manually changing the amount by not using an inflation adjustment on it, it has the same impact of saying, well, over time, they will slowly spend a little bit less on travel. Then we have their out-of-pocket costs, and you can see Sandy is on a healthcare exchange plan, and so we have $1,000 a month budgeted for her plus out-of-pocket costs. Whereas James is on Medicare, so he is over 65. And as we scroll forward in time, we see that when Sandy turns 65 partway through the year, her costs drop, and the first year she's on a Medicare plus a supplement plan, now her costs are estimated the same as James. And so this detailed timeline allows us to see that spending isn't always nice and even. Because Sandy is still working, we also had to add in some expenses that come right off her paycheck, her deductible expenses that come right out of her paycheck, because that's not take-home pay. We didn't want to overestimate what was coming into the household, so we had to put those in there. And then taxes. And I'll show you in our next slide where we're getting these tax estimates from. But Sandy's still working, so she's paying FICA, or Social Security and Medicare taxes. There's federal taxes, and then there's state taxes. Now, we see those taxes drop off substantially here, and I'll explain why. Sandy's still working, so what's going on? Well, as we'll see in a few slides, James has a deferred comp plan that is paying out 2 years in 2023 and 2024. And so that is causing more taxable income. Even though Sandy's still working, once his deferred comp plan is paid out, their taxes are lower. All of a sudden here, we have another year with large taxes. That's usually because we had to take money out of an IRA. And then as we go forward, we have some low tax years. And then once they're on Social Security and have required minimum distributions, we see their tax liability goes up substantially. Now, when I see this pattern, I automatically know there's some tax optimization or tax management that can be done. In reality, during these years where their tax rate might be quite low, we would probably do Roth conversions or take additional money out of the IRA. But we're not going to go into those details tonight. We're just going to start with this basic projection. So now we have this expense timeline, and at the bottom, we can see their total outflows. 231, 250, drops to 198, 205, 222, substantially less, 179. A lot of that depends on taxes. Now, I mentioned taxes, And so we have a very detailed lifelong tax projection that we do that builds in all the components of our current tax code, including the fact that tax rates right now are set to go back up in 2026. And so that means we could all be facing, or is it 2025? Nancy, you'll have to check for me and clarify. Why can't I remember which year?
Okay,
it is 2026.
Yeah.
All right, I got it right. Yay. So here, if I scroll in, again, we see the same timeline, and we have their income broken out into ordinary income and what would be classified as long-term capital gains and dividend, which would be a little bit less. And we are just using a standard deduction for them. And then we're coming up with that total federal tax. And that is a very specific calculation for federal. For state taxes, we're just using an effective rate of 5.6% for them. And so we're able to project out their marginal rate and what their effective rate is each year. Now, if I look at this total federal tax and I go back one slide, it is exactly what you see here. So you'll see that projection match this federal tax line. So that is how we come up with the expense estimates. And we would advise people to lay things out in a timeline format because, as you can see, we don't spend in a linear way. The most difficult part of those types of projections would be the income taxes. And I get frustrated with some online calculators that use an assumed tax rate because you can see here, some years their tax rate's 12%, 15, 25, 10, 10, 28. And so depending on the source of your cash flow, the amount of it that has to go to income taxes can vary substantially. I have seen people retire with almost all their money in non-retirement accounts, not inside a 401k and IRA. And they are amazed at how much cash flow they can have and pay such a low tax rate. On the flip side, I've seen many people who were diligent savers, always maxed out their 401k plans, have millions in a 401k or IRA, but what they're actually able to take home, because each withdrawal is taxable, is not nearly as much as they thought. They forget that almost a third of that balance is basically a deferred tax liability. So the places where you've saved, the types of accounts that you have will have a significant impact on your taxes in retirement. So the next piece we want to look at is covering the gap. So we looked at the income. Sandy's still working. We had Social Security. We have a small pension coming in. I mentioned there's going to be deferred comp payout. I'll show you that in a minute. And then we had all their expenses, and we were looking at how those varied. 200,000 a year, sometimes 220, sometimes closer to 190. So how do we cover the gap? That's the amount that needs to come out of your retirement savings. Well, there's various rules around when you can access these funds. You can access them in many cases without a penalty as early as age 50 if you're classified as a public safety worker. And interestingly enough, the Secure Act 2.0 that passed at the end of the year expanded that definition. So more people will have access to their retirement funds without a penalty at age 50. If you leave your employer after the year you turn 55, during or after the year you turn 55, then you also have access to a 401k withdrawal without paying a penalty tax. Many people don't know that. That's one of the reasons that someone might leave their money in that 401k plan if they needed to tap into it, because once you roll it over to an IRA, you would void that early penalty-free access. At 59 and a half, that's the age where we can all withdraw from our retirement funds without penalty. Of course, if it's pre-tax money, we'll still pay taxes on it. And now then we have required minimum distributions, which have changed again. So a few years ago, they moved the required minimum distribution age from 70 to 72. It is now 73 if you were born in 1959 or earlier. It is age 75 if you were born 1960 or later. Now, the effect of delaying those required minimum distributions, some people are going to need that money to come out of their IRA anyway, so it might not have an effect. That's a long time to wait if you're retired to age 75 before withdrawing funds. But other people will have a bigger window of time to perhaps do Roth IRA conversions. And so there can be some planning opportunities that come with that change. One of the things that you'll look at as you near retirement is whether you want to consolidate accounts. We see that there are many, many pros. It becomes far easier to manage investments. I believe we had a client recently that had over 20 accounts spread out. You know, it would be very challenging to keep track of all those required distributions and how much is going to come out of what and small little trades in each account. There's more investment choices at a brokerage firm than the choices in a 401k plan. Your 401k plan provider can have blackout periods when they change providers. There are sometimes limited distribution options. So, you know, we've seen plans where they will only allow you to take distributions quarterly. We've seen plans that don't allow state tax withholding from their retirement distributions, which is a little bizarre. So we think there's a lot of reasons that for simplification and just as we get older, keeping track of so many things becomes a little more challenging. Changing beneficiaries, addresses, direct deposit when you change bank accounts, all of those things. There's some reasons you may not move funds from an employer plan. Sometimes there's unique options, like a stable value fund is a very unique investment option. They're called guaranteed insurance or guaranteed investment contracts that they will have within plans that offer a fairly attractive fixed rate of return. So sometimes there's some options where it may make sense to leave the money in the plan. And we talked about the fact that rolling it over avoids early access if you are between the ages of 55 and 60, if you actually worked for that employer up until the year you turned 55. So that's a little bit about just, you know, some of the mechanics behind the scenes. In this sample we're going to look at, we bucket everything together. This gap timeline we're seeing in the blue color, and again, I'll make this bigger. We're seeing these non-investment cash flows that came from the very first timeline that we looked at, Jim and Sandy's income timeline. In the and we see that it goes up out here as they begin claiming, you know, Social Security. So she was working and they had Social Security that year. And then out here, we just had Social Security in the blue and a pension. We see the all outgoing cash flow that included income taxes. That's in this peach color. And we see this difference, this gap is what we estimate is the net amount that would need to come out of savings and investments. Now, the reason I say net amount is I'm going to give you some more specifics. We have this withdrawal timeline for Jim and Sandy. And we see specifically that $28,000 would come out of their what we call their non-retirement bucket, $96,000 from a deferred comp, another $25,000 from another deferred comp payout, $10,000 from a structured sale. So we had estimated Sandy sold her business and had agreed to stay on with that employer. And so we have $159,623, $179,067. For those of you detailed people out there, you will know that these numbers are exactly $6,500 a year higher than these numbers that you're seeing until you get out to the 89,787 and all of a sudden the numbers match. Well, that's because in this projection, we have Sandy continuing to contribute to a 401k plan in an amount enough to get the employer match. And so she's essentially putting money into one plan, taking money out of their other savings. And so as I mentioned, this gap timeline is the net amount that they would need from savings and investments. So we take this type of withdrawal schedule that you're seeing here, where we have this total that goes all the way out for life. Here, I only ran, I believe, about the first 20 years of it. but it goes out for the length of the projection. Usually it is to the female spouse's age 90. That's usually how we run the projections. And we calculate these withdrawals that are needed. We turn it into what's called a net present value calculation. So net present value says, well, what would I have to have in the bank today, earning what interest rate, to deliver this set of withdrawals for life? So when we look at Jim and Sandy, the present value of those withdrawals is $2 million, almost $2.3 million, if the discount rate we use is 4%, meaning if we could count on the investments earning a 4% return over time, they would need about $2.3 million to deliver that stream of withdrawals. What do they have? They have almost 2.6, and that creates a ratio of what they have to their expected lifetime withdrawals. And we want to typically see this ratio at 110% or higher. Now, we also create a trajectory. So in this trajectory, this says, well, if on average the portfolio earned 5%, what would happen to their financial capital? And we see that it would essentially maintain itself. That's while Sandy is still working and we have the deferred comp payout. And then they had a planned spend down of principal. Now, not everybody has that. Some people have principal that is growing extraordinarily throughout retirement, and we're telling them, gosh, don't you want to spend some more? Other people, we will do an initial projection where their trajectory is growing, and they'll say, I don't want to leave all that money. Like, I want to go out and do it. And we'll be asked, you know, how can I spend more? Can I make the last check bounce? Well, we run a fine line there. There has to be enough out here at a projected age 90 that if that person were to live to 95 or 100, there still has to be enough. And so there's a balance that we use in saying, all right, well, how much more could you spend without running that risk of depleting the portfolio too early? And so this is, you know, a plan that was designed to find that balance. Now, you may want to know, well, gosh, what is it that James and Sandy have? Just to put this in perspective, this was their estimated net worth statement. They have joint assets, IRA 401k for him and her, health savings accounts, a primary residence and a secondary residence, and they still have a mortgage as we saw in their expense timeline. So they have a pretty sizable net worth to support their spending. So now we've looked at their income timeline, Social Security, pensions, Sandy's earnings, their expense timeline, including healthcare and taxes, the gap, what would need to come out of investments. And the last piece is then, okay, how would you align these investments up to that withdrawal plan? Now, this is something we see a lot, that people will use a 60-40 portfolio, 60% stocks, 40% bonds, and let's just rebalance annually. But when there's a specific withdrawal pattern, that doesn't always make sense. So if we dig into Jim and Sandy's situation, we now have their withdrawal timeline. And I'm going to make this bigger. We can see these deferred comp payouts coming out, and that's not really an account that Jim has any control over. So it's a set amount that will come out. There's very limited investment choices. It's not an account that an advisor would manage. These are pretty much the amounts that are coming out. Taxes will be withheld. There's his traditional retirement, and we don't have anything coming out of it till we scoot out here to 2030. Now in 2030, he has an estimated required minimum distribution of $68,000 on a $1.7 million balance. And we said to meet their lifestyle expenses, they would need to withdraw an additional $100,000. So we always break it out between what's required, and you can always take out more than that. We have Sandy, who is adding to her accounts right now. And that's that $6,500 and the employer match that we have estimated going in. And that goes out to 2027 for 5 years. And we don't have any withdrawals actually projected for her until her full retirement age, which is quite a ways away. It's actually not till, I believe, gosh, I can't remember what year it is actually. Maybe 2037 it might be. So if there's nothing come out of Sandy's retirement account for a long time, why would we have bonds in there? We would propose that her retirement accounts could be 100% equity based on the timeline, that we're not going to need to withdraw a single dollar from them for a long time. Where we will need to withdraw money is from this non-retirement account. They have about $700,000. We estimate they'd need to take $28,000 out, about $50,000 next year, $92,000 the year after, $110,000 the year after. And so we would say that this account probably needs to be invested very conservatively. We would use what are called laddered bonds, CDs, treasury bills that are maturing in these amounts. And amazingly enough, right now, on even short-term treasury bills, you can get over 4.5%. On money market right now are paying 4.36. So it's been years since we've seen that. And so we have an estimated rate of return on this account of 5%. If most of it's invested very conservatively in treasury bills, it might run a little short of that. Or if the Fed raises rates again next year, it might not. We might be able to lock in 5% yields on all of this. And then there's the other income that, again, we don't really have control over. These are set payouts coming out of a secondary deferred comp and business sale. So this is their proposed withdrawal plan. When you look at it in a different view, we can see in green the funds that would be coming out of their non-retirement account. We can see that James IRA, we probably wouldn't take any money out till 2030. And we can see that Sandy, I was right, 2037, we don't need a single penny. And so we would be recommending very different allocations for each of these accounts, but they would all need to work together as a household. For this non-retirement account, here is a sample where we see in 2023, there would be enough cash set aside, so I'm going to ignore that year. In 2024, we see this $47,000. This would be an agency bond maturing or yielding 4.75%. And that would be this bar we see in 2024. 2025, we see 91,000. Those proposed safe, laddered income investments were designed to meet and match these withdrawals here. So that's how you begin to align the portfolio to the actual, many of you who have attended my webinars hear me describe it as a job description, right? So each account now has a specific job description. And so now you're tailoring the investments to the specific job and time frame that account needs to accomplish for you. The last piece of what we do is we go back and take this, we'll use this screen, this entire withdrawal schedule for life. We send it to our investment partner, Asset Dedication, and they send us back what's called the critical path. So it's their modeling process that says for each white dot you're seeing, that's the minimum amount that the portfolio needs to be worth at the end of each calendar year for this plan to work for life. Meaning the last check bounces, you die with $1 in the bank. It's not the expected path. We expect the path will look better than this, but it's a worst case path to measure against. And they can calculate what's called the minimum return that is needed for this path. And that minimum return is 2.58%. It's very reasonable. So if we see minimum returns higher than 5%, that means that this portfolio would have to take a lot of risk for it to have a chance to work. And that would make us a bit nervous. There'd just be more risk in making that portfolio work. Perhaps that person might want to look at spending a little less so that their minimum return would come in a little lower. But at this minimum required return, this plan looks very good. Then asset dedication goes back in history and says, okay, if you had invested using this income ladder, very safe investments maturing each year, in this sample, I just ran this earlier this week for this presentation, and usually it's a longer time frame, so I must have done something wrong, because what I got back was each 23-year period. Most of the time we're looking at 30 or 33-year periods, but it gives you an idea of the testing process. Each yellow line represents a distinct 23-year period, starting back from, what if this was James and Sandy retiring in 1927? What if this was them retiring in 1928? What if this was them retiring in 1930? And so we see two yellow lines didn't make it. Those would have been Great Depression era retirement scenarios. Now, they didn't make it, assuming they made no changes to their plan, right? We kept giving them inflation raises at 3%. They kept the vacation spending. They kept all of it. So in reality, if one of those Great Depression scenarios materialized, there would be changes. There would be along the way, we would say, let's skip your inflation raise this year. We're going to have to forego the vacations. Changes that, of course, we always make. Many of us made them when we went through the Great Recession in 2008 and 2009. So seeing that most of their scenarios tested over all of these various time periods finished in the yellow is wonderful. And as they go forward, if we're 4 or 5 years into their plan, as I tell people, you only get one yellow line. It would be great if we could pick which of these lines, which point in history, what will our market scenario look like during our 20 or 30 years of retirement, but we don't get to pick. And so we track as we go along, and if the yellow line is up here in the green fairly early on in retirement, then additional spending can be built in. And if the yellow line is down here in the red, then usually we're foregoing inflation raises. Not in a single year. There's events like COVID, like March of 2020, where the yellow line dips into the red, but we felt like it was very temporary, and it was. And so those kinds of events don't concern us. But if it was many years of being in the red, then there would be a different kind of conversation around how do we readjust your plan in order to get back on track. That is, in our view, best practices for how to build a retirement income plan. In just a minute, we're going to open it up to questions and answers, as we always do. We often get questions about our services. So a quick preview, we work with couples and singles who are already retired or within 10 years of retirement. Our services always start with a complimentary meeting where we walk through what we do in great detail. It can be in person if you're local, but we work with clients, I believe now it's certainly over 33 states across the US that we work with, even one in Alaska recently, and we've had them from Hawaii. I often get asked if you can work with me. The firm has grown to the point where I cannot work with new clients. I wish I could clone myself. But the next best thing I've found is this process that I'd like to say I designed it, but I've had so much help. We have just amazing financial planners. They have contributed in unbelievable ways to making this process better each and every year. We all use the same standards, the same metrics, the same process. And so unfortunately, no, I'm not able to work with new clients, but I do help all my planners in the background. And we've just got just a really incredible culture where we help each other out, ask each other questions. Does anyone know this? Have you seen this? Can anyone jump on a web meeting and walk through this? So we are very, very collaborative in service of giving the best advice that we can. You can always go to our website and fill out what's called the pre-meeting questions. You'll find it under the services tab. That's how it starts. That questionnaire comes back to me. We respond. We let you know how far out we're scheduling. We have had a wait list almost consistently since last May. Right now, we're scheduling introductory meetings out for probably about the middle of March timeline. That's how long it will be before someone has availability. So all of that being said, Nancy, I know I've seen the questions popping in. I've tried not to look over at the question box so that I didn't get distracted.
I tried to not distract you while you were talking.
Well, fantastic. I think we're ready. And, as those of you know, we like to stay on. We try to answer every single question. If we don't get them answered, Nancy will typically follow up with you and try to get you an answer.
Yep. All right, so lots of questions here, Dana. Let's start at the top. Question about Roth conversions. How to make Roth conversions without hitting the net income tax and kick up to a higher IRMA?
It's a really great question, and sometimes there is no way to do it. Now, the Roth conversion itself won't necessarily force you into the net investment income tax, but if you have a large portfolio of non-retirement account assets, not inside an IRA, then yes, then you're likely gonna hit that. IRMA is what's called the income-related monthly adjustment amount. That is the technical term for Medicare Part B means testing. And so we do have cases where Roth conversions put someone into a higher Medicare premium, but we model that out and we can say, was it worth it? You paid that extra premium for a year, but did the tax-free growth on the Roth overcome, was that more beneficial to you in the long run than that extra premium? And in many cases it is. So just because you would be in an IRMA premium doesn't mean you should necessarily forego a Roth conversion. And that's particularly true right now and next year because of the tax rates that are projected to go up in 2026.
Yep. What happens with Social Security in 2035?
2035, well, I don't believe anything's going to happen to Social Security in 2035. So if you're referring to the trustees report and when they say that, Social Security funds are going to run out, what they're really referring to is at that point, the money coming in from those of us paying into Social Security would cover about 75 to 85% of the benefits out. So in a worst case scenario, I suppose they could say, oh, we're only going to pay out 75 or 80% of the benefits. And every once in a while, we have someone who wants us to model it that way, and so we can. In reality, Social Security was supposed to run out, and I believe it was 80 or 82. And they waited, of course, till a few months before the fund, quote, ran out. And then they made all of these changes. One of those changes was the odd full retirement age schedule that we see today, where, if you were born this age, your full retirement age is 66, but if you were born this age, it's 66 and 4 months, 66 and 6 months. And so those changes that they put in place was a 50-year fix, which got us almost exactly to 2032, 2034. It was, it worked almost exactly as the actuaries said it would. And so the real question is politically, will there be any motivation to come up with some changes, anytime before the last minute? Or will it be 2030, 2032 before they finally legislate and actually make some changes? We don't know. But there's some small changes that could be made that would not have a big impact on, on most demographics. And usually when they implement those changes, people past a certain age are grandfathered in and they schedule those changes in for the younger generations.
My understanding is that even if you wait until 70, the max benefit for the spouse is tied to full retirement age. Is that correct?
Well, you're talking about, I believe, survivor benefits for Social Security. Yeah. So, not really. So, if somebody delays claiming, so let's say, you're the highest earning spouse and you're going to wait until 70. Well, the Social Security doesn't want to penalize. What if you die, right? What if you die at 68 or 69 before you started claiming? Well, your spouse isn't going to get penalized for that. They're actually going to get whatever you would have gotten if you claimed at 69. Now, what you might be thinking of, there's spousal benefits are different than survivor benefits. So spousal benefits, the maximum amount you can get if you were a lower earner and your spouse made a lot more than you, then you would get 50% of their full retirement age benefit amount at your full retirement age. So that is a cap, and you don't get any more on that spousal benefit from them waiting to 70 or for you waiting till 70. But survivor benefits are a different set of rules. So there absolutely is more that goes to a surviving spouse for waiting till 70.
A couple of questions, Dana, on software, and maybe you want to talk about what software and Excel and Excel kind of being in the background of software. But a couple of questions regarding our software. I believe Dana uses Schwab, but what financial planning software package or system does she use?
We use our own. We have, occasionally demoed Right Capital. We did demoed for a few years. New Retirement is an excellent system that's out there. You can go to newretirement.com. They have built in some great tax functionality, but anytime we try commercial software, our clients are complex. We need to be able to fit in things like, a software package we used to use that we loved, but it went off the market. We loved it, but it still didn't allow us to put in HSAs accurately. And so there's always these features, particularly when you have deferred compensation plan and stock options and rental property, that it's very hard to fit those things into the software. So for that reason, we use our own.
Dana, I think this goes back to the whole, health insurance slide, because the number 18,002 seems to resonate. What are examples that would be in the bucket of 18,200 to make it so with multiple O's expensive?
Well, we can go back and see there was the premium component of that, and then there was the out-of-pocket component of that. And so I'm gonna, here we go, 18,200. I see that. Okay, so that was all out-of-pocket costs in there in a worst case scenario. This is Medicare without a supplement plan, right? And so amazingly enough, I have an answer. Initially, I was like, oh no, I don't know that, but I do. If you don't have a supplement plan, Medicare will cover on average about half of your healthcare expenses. So many people think of, Medicare is going to cover everything, but it's simply not true. And so that's why you see this big difference here between someone without a supplement plan and someone with a supplement plan. The supplement plan is picking up all kinds of things that Medicare without a supplement will not pick up. And so you'd have to talk to a healthcare agent to get exactly what are those things. Is it prescriptions? Is it lab costs? Is it certain diagnostic tests where if you have a supplement plan, it's going to come in and pay more. So you'd have to talk to a healthcare agent to find out the specifics. But the difference here is someone with and without a supplement plan.
So do you need a supplemental plan if you get retirement benefits through your employer?
So I don't know. So if you have retiree health care through your employer, in most cases, I would say no. You're going to have Medicare, you're going to have Part B usually, and usually you are not going to have a supplement plan. But I always like people to run those questions because each plan is different through, a specialized agent that really deals with this all day long. But in general, I'll give you in most cases, a no.
When people take money from their IRA for living expenses or because of RMDs, are there instances where they shouldn't put the leftover money to the Roth IRA each year? Since they must pay taxes either way, in my opinion, it's best to put that $2,000 to $5,000 surplus left into the Roth.
Well, that would be nice, but you can't. So your required minimum distribution cannot be converted to a Roth IRA. And so you would have to take out your distribution and, then you would have to take out extra money to convert to the Roth IRA. Now, if you are still working and have earned income, you can make a contribution to a Roth IRA. So you could be taking money out as a required minimum distribution, and then you could be putting up to, the maximum Roth IRA contribution limit, but you have to have earned income in order to contribute to a Roth IRA. So no, you can't convert any portion of your required minimum distribution to a Roth.
Yep. We are, just as a side note, starting to see more people use the qualified charitable distribution.
We are, and
RMD, yeah.
That's a great side note, Nancy, because qualified charitable distributions, you can begin to use those at age 70, even though now your required distributions don't start till 73. If you normally make charitable contributions, and you make them directly from your IRA, then the distribution from the IRA doesn't show up as part of your adjusted gross income. And that has other favorable benefits on your tax return, such as the IRMA premiums we were talking about, taxation of Social Security, and so on. So if you are charitably inclined anyway, gifting directly from your IRA once you're age 70 can be beneficial.
Dana, this is going back to a slide on the net present value. So the question is, does the net present value of 1.98 million at 5% discount mean the value today and this couple will be able to spend mid-$100 a year going forward? Are those forecasted spending amounts in future dollars then? So the discounting is really 3%. The growth is 5%.
I don't know. I'd have to have you read that again. I'm not quite following that question, but I can explain.
Well, so the net present value of 1.98 million.
That is the net present value, if the portfolio, could be assured of earning 5%. And so it's the gap. So it's the portfolio withdrawals that we looked at. Let me move here, projected for life, right? So it's the net present value of those using, going the wrong way, either a discount rate of 4% means you would have to have saved almost 2.3 million to cover those withdrawals if your portfolio averaged 4%. If you could be assured that your investments could earn 5, you wouldn't have had to have saved as much, right? You would only have had to have saved only 2 million to cover that same withdrawal pattern. Now, we don't like to, assure that someone's going to earn that. So we want to see 110% fundedness ratio at this 4% discount rate. We feel that that is a reasonable assumption. And again, we were using inflation on the expenses already. 5% is likely achievable, but there have been several periods of time in history where a well-built 60% stock, 40% bond portfolio earned a compound rate of return less than 6%. And so it depends on how conservative you want to be. Our view on retirement planning is if we get a good stock market or good market in general, right, you're going to be just fine. You're not going to have to worry about any of about your spending. You're going to be okay. But it's always the worst case scenario that we want to plan for. So we want to plan for a minimum level of consumption that your plan can work for life regardless of what the market does. And so that's why, we use this 4% really as our main testing parameter. But yes, if you could be assured it would earn 5%, you would need to save less to have the same amount of withdrawals.
I was thinking about the liquidation value at the end. I wasn't thinking fundedness. So yeah, 4%. The next question is, are bond ladders always held outside of your 401k or IRA?
Bond ladders can be inside an IRA, absolutely. Within a 401k plan, you can't buy individual bonds or CDs unless your 401k allows you that option to open a separate brokerage account, and then you can. The challenge with that is if you leave that employer, sometimes you have to liquidate everything in that outside account to roll the money out. And so it's frustrating. They should make it more seamless that portfolio can transition with you without having to rearrange your whole investment structure. But absolutely, you can buy bonds within an IRA. No reason why you can't. It's just very difficult to do within a 401k plan.
Do you have a sample Bob and Sue plan you can show us? I'm not sure, Bob and Sue. But I think what this person is looking for is, do we have sample plans and what does a typical plan look like? I think that's
we just showed you. So everything you saw is exactly what we do for each of our clients. Now, we run all of the numbers, you get copies of all of the numbers, but we also summarize it in a set of reports. So we try to simplify and educate through a series of presentations, much like this one, as we go through our planning process. But yes, everything you saw tonight is a sample plan. It's exactly what we do.
Is the historical audit another version of Monte Carlo success percentage?
It is not. So it's a really great question. So the historical audit is one of 3 retirement readiness tests that we run. Monte Carlo is the first one that we run, but Monte Carlo is a very blunt, broad tool. And if you read some of the detailed research on it, you will find that a lot of, retirement income nerds don't place a lot of value on the Monte Carlo analysis. It often is testing scenarios outside of what we're likely to see in reality, but we do use it. The historical audit is testing real life history. So Monte Carlo is a simulation, right? The computer simulates random returns and then runs your portfolio and your withdrawals through that random return pattern. In real life, if the stock market goes down too much, right, people swoop in to buy, the factors are often related. The historical audit is real life. Like, it is what really happened if you made, invested in this way, retired in 1927, took this pattern of withdrawals. So it's testing the portfolio over a real life set of scenarios. There's a really cool fellow retirement income geek. His name is Jim Otar, O-T-A-R. I believe he's Canadian. You can Google his name. He has a book where he talks about aft casting, and that this historical audit is a form of aft casting, meaning, rather than using Monte Carlo, can we actually test over real historical conditions? And so I think, all of the different fundedness tests, we use the present value as our third retirement readiness test. They all have different strengths and weaknesses, and because retirement's so important, we use all 3 of them.
Yeah, looking at plans just in very, very different ways from different angles. So along those lines, Dana, how do you know, this is speaking of the historical audit, how do you know what yellow line to use, or is that, or which line you're on? Which line it would be your line?
Yeah, we track it, so we don't know, right? That's the uncertainty. I mean, what I love about this historical audit is it tells you, depending on which point in time you retired in history, right? Your experience can vary tremendously. If you look at a retiree who retired in the early 80s, that was probably one of these yellow lines that shot right off the top. But if you retired in the Great Depression, right, you were here. So we don't know what the future is going to bring, and you can manage the portfolio just right, and you still can have a vast difference in outcome depending on the point in history that you're in. And so that is the challenge of doing this type of modeling and testing and making sure that, I've described it like a flight, an airplane flight, like we're going from New York to LA, and this set of dotted white lines is our flight plan. And it's never going to work exactly like this, but we're going to have course corrections along the way. So if we're in the red, we kind of go, oh, we're off track. What are we going to need to adjust to get back into the green? Now, if we're way up here in the green, we're still off track, but in a good way. But we might say, oh, you could spend more. But how we know is we're tracking your portfolio value, your financial account values against this initial plotted path. And so that's what tells us over time where you are or what your yellow line looks like.
Where is the factor for the 1 to 1.5% loss for financial advisor fees that are guaranteed?
I love it. Fees are guaranteed. Yes. So what we do is we have when we look at the historical returns of a 60/40 portfolio, those are already built into the estimated returns. And so when you look at the return of a 60/40 portfolio over one of the worst decades, it was a compound return for that decade of about 6.5%, and that was one of the worst returns, worst decade returns. You net out 1.5% fees, and so we're typically using 5% in our projection model. So we've already factored it into the projections that we use.
Okay, we have a lot of questions, so buckle up. It's going to be a long night. I'm turning 61 this year, and I just started a health savings account. Since I won't have very many years to invest, do I invest all in a mutual fund, or do I, or a specified HSA account with a 0.44% interest rate?
That's a hard question. So it really depends on when you're going to use those HSA funds, right? My philosophy on HSAs has been I like to keep 1 or 2 years worth of deductible, what I think I might use, in a safe part of the HSA, like a money market fund or something, unfortunately, that's not earning much. And then once I've built up that part that I might need to use, then the rest I can invest in a mutual fund that has a little bit more risk. It could be a balanced fund that's stocks and bonds. It could be 100% equity, depending on my time frame. So it's really hard to answer that without knowing, if you don't have a lot of additional savings and a health event came up and you would have to tap into this HSA, do you want to also take the risk that the market could be down? I believe Nancy and I were reading a question that came in before the webinar, and it was someone who had said their HSA was down 25%. Well, that can happen if it's fully invested, and if you're used to taking money out and you didn't keep some in a safe piece, then what do? Well, you can save up all your receipts for your HSA if you have some other way of paying it, and then wait until the investments are doing well and take all of the expenses out at once. So you can do that, and there is no time limit on when you can do that. So you could take expenses out of your HSA this year for money for healthcare expenses you had a long time ago, as long as you had the HSA and it was all documented and you had the receipts.
You're gonna enjoy this question. Why do you call it a juicing plan?
So it's great. We have some people who, are offended by the term. I had one person who thought I was referring to steroids or something. No, so the story is there is a restaurant, a breakfast place here in Scottsdale called Butterfield's, and I was having breakfast there one morning while Sensible Money was being started, and they serve fresh squeezed orange juice. And you watch the oranges roll through this contraption and into the juicer, and it's just absolutely amazing orange juice. Well, I was there on, I believe it was a Monday or Tuesday morning. I had been at home the weekend before making homemade margaritas, hand squeezing, these oranges and lemons for my margarita. I put, fresh squeezed orange juice in mine. And there was always extra juice left over in the rind. And so, I was watching these machines at the breakfast place, and I'm like, wow, I bet they get more juice out of every orange than I'm ever going to be able to do at home with my hand squeezer. And so I was going to initially write a book. My book that I wrote was going to be called Juice, How to Put More Back into Your Cup. And so I'm glad I didn't call it that. I think Control Your Retirement Destiny is better. But that's what I was going to call it. And so I was talking with my marketing person about it, and he was like, oh, that's what we should brand with. And so we did, because it was different. And for us, it's really about, how do we squeeze everything we can out of your assets by coordinating them? Not by juicing the returns. It's not an investment strategy at all. It's a planning strategy. It's by saying, well, okay, the juice is already there as it is in that orange, but if I'm using the wrong equipment and I don't know the rules and I haven't coordinated it, I'm going to be leaving something on the table.
Someone pointing out that QCD is 70.5, so you don't want to make any QCD distributions until you've actually hit 70.5 and beyond.
Thank you. I forget about the half.
Yeah, that's right. Can I hire you just to create and monitor the plan versus managing the assets?
We do plans. Yep. And so, when clients come in and just go through the planning process, matter of fact, our whole process is structured so that we will not manage assets unless someone goes through a very thorough standalone planning process. We would find that the majority of people who go through that process do actually eventually hire us to manage the assets and deliver the retirement paychecks in the plan. But some people will go through and then they might come back. I just had someone come back for the third time. They did their first plan in 2017, and then they did one in 2019, and now here they are in 2023 coming back to go through it again and just do a checkup.
I think part of the question, Dana, though, is monitor. Like, can you do a plan and monitor investments without managing them? I think the answer is
no. We really can't. When you try to do that, like trying to link accounts to the system, it's almost impossible. The links break. It's really, really difficult to do.
Yep. Can I use capital loss carryover to pay for Roth conversion?
Oh, not exactly. So, capital loss carryover can offset capital gains, and up to $3,000 a year of capital loss carryover can be used against ordinary income. But that's not going to cover a whole lot of Roth conversion. So that kind of capital loss can't offset, more than $3,000 of ordinary income. And when you do a Roth conversion, that's all ordinary income on your tax return.
Another question that comes up just about every webinar: when will we see your new edition of Control Your Retirement Destiny?
So I'm actually hoping that this is the year, because what I've been waiting on was all these changes that just came through with Secure Act 2.0, right? They've been pending for several years, and I thought, I do not want to upgrade, redo my book, and then they go and change the required minimum distribution, or change this or change that. So it's just been, it takes a lot of time, and right now with the growth of our firm, we are trying to hire still, but there just hasn't been time to do it. And so this might be the year.
The national debt grows and grows. For that, if it ever becomes a major problem.
What's the question?
It's more of it begins with a statement. The national debt grows and grows. The question, I think, is any planning for that if it ever becomes a major problem?
That's probably beyond the scope of this. If you really gonna plan for that, I've told people in the past, I've had people look at getting different citizenship. I've had people look at, if you really want to be safe, buy land, buy cows, buy chickens, stock up on batteries, guns, ammunition. It's very difficult to plan for some of the very extreme events that, it's just difficult from a traditional viewpoint.
Yeah. Long-term care life insurance, is that considered in your plans?
Yes. And so we look at, whether someone still needs life insurance, if they have existing policies, what is the most effective way to use those. In some cases, the answer is you don't need it anymore, but there could be tax consequences to cashing it in, or there could be other options. You can convert them to annuities. And with long-term care, yes, we're looking at, what your future long-term care costs could be and what are the different ways that you could pay for that. Many people fall into the self-funded category, where they're likely going to have enough assets to be able to cover those costs. And so in that Vanguard report that I mentioned, there's a whole page in that report on long-term care where they show that, I believe it's about 15% of people will have high long-term care costs. It's about $250,000 or more in total costs over their lifetime. But half the people will have no long-term care costs, and everybody else falls in the middle. And so depending on your asset size, if you needed to cover, the high end, about $250,000, well, you're also, when you have long-term care, you're not going to be traveling. You still have your Social Security, or if you have pensions, you still have those sources coming in. So, and oftentimes the home gets sold at that stage, and so there's home equity to help cover that. So we do look at that type of analysis.
Do you do detailed RMD analysis and tax planning?
Yes.
Yes, that's what we do every
Very
day.
much so, just like you saw in the tax schedule that we looked at, and the projected RMDs that we looked at for James and Sandy.
Are the investments always in equity and bonds?
Yes. I mean, mutual funds, exchange traded funds, agency bonds, municipal bonds, CDs, money market, a combination of publicly traded securities.
Given higher interest rate environment, do annuities look more favorable compared to previous years?
They probably do. I haven't run an annuity analysis recently, but usually when there's higher interest rates, they do look more attractive. And I should say, when I talked about we use publicly traded securities, through the planning process, we do have conversations around whether an annuity is a good choice to add into your plan. We don't sell annuities. We don't receive commissions from the sale of any products. So we have partners that we work with that we can go get quotes from. And if we think that an annuity should be part of your plan, we do take a look at that. Typically, we look at that in terms of what we call your coverage ratio. So when you get out into your early 70s, mid 70s maybe, that's often when cognitive decline behaviors can show up. And so how much of your cash flow is covered by guaranteed income? Pension, Social Security, those kinds of things. And if that ratio is less than 50% for a lower net worth household, then maybe it makes sense to add in some annuity income. Now, for higher net worth households, sometimes it might not make sense from a mathematical standpoint, but the largest client we ever worked with that wanted to put money in annuities wanted to put $2 million in to guarantee a specified amount of minimum income. That's just what made him feel safe. And so, there's a lot of preference that goes into those types of discussions and decisions.
Jana, somebody asking if the forms that were shown today would be available, or can they find samples on the website?
No, I don't think we have any of those samples on the website.
Do you perform tax loss harvesting? This is a great question. Is it worth it? It depends.
Oh, right? Yes, we do.
Yeah.
And but we don't do it blanket, meaning like if you go to Wealthfront or some of the online, investment advisors, the robo advisors that have come out, like they do automated tax loss harvesting. So we actually look at a client's tax situation and tax projection. Let's say they already have capital loss carry forward. Well, I don't need to generate more losses. Or let's say if I realize capital gains, they're going to fall in the 0% cap gains rate anyway. Well, then I don't need to do any tax loss harvesting. On the other hand, once you're collecting Social Security, that tax loss harvesting and using 3,000 of it against ordinary income can have some beneficial impact on other aspects of your tax return, like the formula that determines how much of your Social Security is taxed and so on. So yes, we do it. And, we try to do that analysis really based on the client of is it worth it or not. If done right, yes, I absolutely believe it's worth it. You should be exchanging same day to same day, in a like kind security. What happens is if tax loss harvesting is done where you sold one day but didn't buy something till 2 days later, the market can move 4 or 5% in that time frame. You could lose all the benefits of your tax loss harvesting. But it should be just an instantaneous. You sold one thing and at the exact same time bought something else, captured that loss. Now you can use it on a tax return. The market recovers. You didn't miss out on any gains from that, and the transaction costs are almost nothing today.
What are some key thoughts, Dana, about Roth conversion optimization, and maybe it's around how do we kind of get to that place?
Well, I did a video with Bob Powell, I believe last year, where we talked about there can be too much of a good thing. And so, there is a way to project out your tax rates, as we saw in this tax schedule that we looked at for, I'll go back to it, for this sample that we ran. Let me go back to this was their tax rate estimates. So there is a way to project out your tax rates for life. And if you over convert in the early years, I've seen, cases where someone wanted to convert, they just had in their head, I want to convert everything. Well, they would be paying 32%, sometimes 34% tax rates early in retirement. And then later in retirement, they were at the 10% tax rate. Well, I look at that and I go, well, that doesn't make any sense. So you don't want to convert so much that your tax rate's so low later that if you had just left that money in the IRA, you could have pulled it out and only paid 12% or 15%, right? So there is, a way to project that out and say, I've heard some people say, well, you can convert enough so that your required minimum distribution is about equivalent to your standard deduction later in retirement. Well, to me, that doesn't make sense. That's still over converting, because the first two tax rates are going to be 12 and 15%. Those are pretty low rates compared to what most people would pay when they convert. So it's hard to answer. We can't give anyone that answer without actually running the projection and saying, well, here's how we can convert up to the 15% or up to the 22 or 24% tax rate. And that all depends on where your tax rates might be later in life.
Do you provide a secure upload tool or rely on email for clients to submit their financial information required to complete the juicing plan?
We use Box, so yes, it's used by a lot of Fortune 500 companies. It's an encrypted, secure, upload portal where you can upload directly and log in, and we can upload and see things. So we encourage people, use email to address general questions, of course, and dialogue back and forth. But in terms of financial statements, anything with account numbers, social security numbers, or tax returns, no, we don't want any of that by email.
Question is, please repeat the 3 ways you test for retirement readiness: historical, performance analysis, Monte Carlo, and the third. And I would also just throw in there, I don't know if it's not really the 4th test that we run, but you had written that academic paper on household fundedness. And I don't know if you want to touch on that as something else that we look at.
Yeah, that's a great point. Thank you, Nancy. So let me, first part of that question, the 3 retirement readiness tests we use. First is a Monte Carlo, and our planning process is broken into a series of strategy meetings with specific topics that we cover, and the order that we go in is very intentional. So we start with very big picture. Does your plan work? Do you have enough to retire at about this age with about this much lifestyle spending? And so we run a Monte Carlo analysis on that helps us see if we're in the right, if we're in the ballpark. If that Monte Carlo is too far off, there's no point in us going forward until we say, you're going to have to work a few more years, or we're going to have to reduce spending, or we're going to have a downsize. So once we have that in the ballpark, then in strategy 2, we look at, are there any ways to optimize or manage this for taxes? So would Roth conversions help? Are there going to be years where your tax rate's low? What order should you be withdrawing from? Should you be taking from your IRA early or not till you're 73? And so when we've got that, that's when we run this fundedness test. And so you saw an example of that here. This is our fundedness ratio that's taking the present value of your expected lifetime withdrawals and comparing it to your current assets. And that's a specific analysis that comes out of the Retirement Management Advisor curriculum that myself and all of our planners that work with retirees hold that designation. Then the third retirement readiness test is the historical audit. And so that is the one, my favorite, I call it the spaghetti chart, all the squiggly yellow lines, that takes your specific withdrawal pattern, goes back and tests it as if you had retired each year starting in 1927. Now, the second part, so Nancy, you brought up, if you go to our website, there's a Learn tab, and under that Learn tab, you'll see a set of resources. And I did write a paper called Demonstrating Advisor Gamma with the Household Balance Sheet, a technical paper for other financial advisors. It was published by the Investments and Wealth Institute, and it won an award last year. And so it is an example, again, of our planning process and of this household fundedness concept. It's pretty detailed, but for those of you who love all of this stuff, as many of you do, and that's why you're here, then you could go on our website to the Learn tab, then to Resources, and you'll see a thumbnail, and the paper is called Demonstrating Advisor Gamma with the Household Balance Sheet.
Do you recommend using HECM, reverse mortgages, for long-term care expenses?
I'm not so much a fan of using those for long-term care expenses unless you're sure you can stay in the home. So with a reverse mortgage, right, you have to be in the home. Like that's one of the requirements. You're not supposed to not live in the house for more than 12 months. And oftentimes if you're needing long-term care, it may be that you're going to need to go somewhere. And so I think that's a bit of a risky strategy. I think reverse mortgages can be good tools to use early on in retirement. They produce tax-free cash flow when they're used correctly. But for long-term care, again, you have to stay in the home. And if you had to go to a facility that could void your reverse mortgage, I think it's a bit risky.
If you plan to sell your home and move to assisted living later in retirement, how do you minimize the taxes on the home sale?
Well, it depends on how long you've been in the home, right? If you're single, you get to exclude $250,000 of capital gains from income taxes. If you're married, it's $500,000 that you can exclude. And beyond that, there's not a great way to minimize it. If you did have capital loss carryovers from investments, those would offset the capital gains on your house. But other than that, anything over your cost basis, right? So you get your cost basis, what you paid on the home, plus any qualified improvements. You can go to the IRS website and see what those are. If you've been in the home a long time, what we find is people often spend a lot of money on the house that would count as a qualified improvement, but they don't have any of the records. And so you really need the records to be able to add those expenses to your basis. So you could track all of that down, basis of your home, what you paid for it, improvements that the IRS considers qualified improvements, you can stack those on, and then you get an additional $250,000 or $500,000 of gains you can exclude based on whether you're single or married. So that gets you a good way, a fair amount that you could shelter from taxes. Anything above that, you will pay at the capital gains tax rate, which is a lower tax rate than ordinary income.
Here's a question. Do you have a Florida branch location on the website? And as I'm thinking about this day, and I'm thinking of the roughly 50 or so clients I'm working with, I think only 2 are in South Carolina. Everybody else is, several states away. So
no, we do have our tax specialist Julio lives in Florida. He lives in Miami, and so Kathy, who's not on the webinar, she's in Massachusetts. Nancy, who is here, is in South Carolina. So we do have employees in different places. We have a financial planner in Indiana. We don't have a branch in Florida. If you downloaded our ADV or saw a Florida address, that's probably because we had to record one of our employees that lived there. But no, we don't have a branch. The only physical office we have is where I am right now. We did just expand it, but we are in downtown Scottsdale. But we work with clients remotely all over. But some people, we understand, aren't comfortable working remotely. And in that case, it would be important for you to find someone local if that is important to you.
Question on QLACs. What factors determine whether it's a good choice?
So a QLAC is a qualified longevity annuity contract that you can purchase within, your 401k. I believe they just increased the amount that you can purchase, but I don't know the year that kicks in. Many of the provisions in the Secure Act that just passed don't start right now. And there was, I believe they said over 100 different rules or provisions they changed, so it's impossible to remember them all. But it's basically an annuity where you would set aside a sum of money today. The maximum amount used to be $125,000 or 25% of your balance. I believe what they did is eliminate that 25% of your balance requirement. And so then it wouldn't start paying you income until you were 80 or 85. The general theory is that, well, then between now and 80 or 85, you could spend all the rest of your assets more confidently knowing that this income stream was then kicking in at a much higher amount to cover your later years. So, I think they're an interesting tool. The challenge I find when we're doing our planning is that a lot of times at 80 or 85, if you are married, you could be a surviving spouse at a much higher tax rate at that point, and that QLAC is going to create essentially a deferred tax bomb where you have much higher cash flow coming in from taxable income at that point. And so, but I can see for a single person, I can certainly see strategies where they would fit. I haven't personally encountered one of those strategies yet where I thought they were a good fit. So there's a lot of tools out there. I don't like to be biased. I think they all have their place. I just haven't encountered something yet where I thought a QLAC was a really good fit.
How do you account for a pension that is not inflation adjusted?
We don't apply an inflation adjustment to it. And so, it's just in there as a flat dollar amount, and it doesn't increase over time.
Yep. Are we using any fixed deferred annuities instead of bonds for the fixed income portion of the portfolio?
Not usually. If you could earn substantially higher yields, you could. It could be very challenging because the way we use fixed income is it's maturing and we are consuming that bond or CD when it matures. And so that could be a lot more challenging to do with annuities. If they're IRAs, it's a little easier. Every dollar that comes out is taxed. If they're non-IRA annuities, taxable income comes out first, and then return of basis comes out second. And so, we find the logistics of implementing those and tracking and managing is just, very, very challenging. And so it's simply, not worth it logistically to try to keep track of all of those different contracts.
Can I do Roth conversions if I have a rollover IRA? I had a pension payout that rolled into an IRA and thought some experts said that it would compromise my ability to do Roth conversions. I'm 64 if that matters.
You can absolutely do Roth conversions from a rollover IRA. So I don't know why, maybe it was a misunderstanding. But yes, you can absolutely do Roth conversions on an IRA rollover.
How do you handle legacy and estate planning?
Well, it depends, like so many things, right? It depends on the client. But we do, want to talk about your beneficiaries. And we have some clients that will, via web meetings, or if they're local in person, bring in future generations at a certain stage. As clients get older, I've had cases where we needed to add a trustee. You could tell that mentally things were starting to shift, and so we would add an adult child to, as a trustee to their trust. So these are conversations that we have, and we're not estate attorneys. We can't do the documents for you, but we can explain how things work. We can explain the taxation. We can take a look at how your accounts are titled and your beneficiaries are structured and say, okay, here's what would go to who, and is that what you want to have happen? And so that's how we do all of that.
Okay, great. A couple of people have said that they are going back to the paper. They are able to access it. So either way, we'll still send it out. But thank you for people actually are checking this stuff out while we're talking. Would it be better, I think, to use maybe reduced defined pension with joint survivor? Or keep term life policy for the same value of a full pension value?
So I have run those analysis before, right? Basically, the question is, would it be more efficient to keep a life insurance policy, right, and pay the premium and take my single life pension option if I'm married, or would I take a lower pension option that's going to pay out over my joint life with my spouse and not have the life insurance? And so the problem, with the term policy, of course, is that, it will get very expensive as you get older. So you could buy a term policy for a fixed 10 or 20 years, but, when it goes to renew, it would become unaffordable to you. But the other challenge is that, and I saw this happen in real life, it was with a client's parents who had a whole life policy their whole life, but it still had premiums. It wasn't paid up. And they experienced cognitive decline, and, kids had to help them get into a home. They missed that life insurance premium. The policy literally expired like 2 months before dad passed. And so the challenge I have with some of those strategies is that it can be easy to, when you're going through a stress, to miss an insurance premium, right? And a lot of people don't like to set up everything automatically. I'm a fan of that. But yeah, so that's a big risk that you would take that strategy and then something would happen, an illness or health event, and you miss that term insurance premium and poof, your strategy just through a kind of ancillary risk didn't work.
Yep, I've seen that over my years.
Yeah. Well, I'll tell you another story. Sorry, I just, if people are still listening. So I have a client I've worked with since about 2004, and 2 years ago, his wife was very ill, and he received a notice on her life insurance policy, and the premium was going up, but it wasn't drastically, and he was going to cancel it. And she was in the hospital. I knew he had told me what, and I didn't want to personally say to him, I don't think she's got very long. People get where they're not thinking clearly, they're not hearing clearly, but I was able to say, no, you absolutely should not cancel that policy. And so he didn't. He paid the increased premium, and she did pass 3 months within 3 months. And so it wasn't a huge amount, but it was $50,000. Simply by having someone there to say, no, don't do this, that was $50,000. And so, again, I just see that when people get to a certain age, it's like sometimes they're not thinking as clearly as maybe they would have been.
Do you charge a percent of assets or a fee-based?
Well, so those terms in the financial services world mean the same thing, but we charge a flat fee for our financial plans when someone first goes through the process. And then if they move into what we call our Juicing Plus service, where we are managing the assets, then we do charge a percentage of assets. And it starts at 1.25% on the first million and then tiers down. And so the rate gets lower the larger the asset size.
Somebody's asking, how much is the fee for running the plan?
Right now, the plan fee is priced at $6,900.
What's the minimum amount of assets for a new client to bring to entice Dana to come out of retirement? LOL. So.
Oh, well, I'm definitely not retired. Matter of fact, that's the challenge, is I'm, as my team knows, I'm working right now to figure out like how to actually take a weekend off. And so, truly, you don't want me to be your advisor right now. And so I shouldn't say I got existing clients on the line who are like going to call me tomorrow and say, hey, transition me to someone else. And so
your mailbox is going to blow up. Yeah.
But yeah, my time is full. And so, I just don't have the capacity. So you wouldn't even, it doesn't really matter, right? It wouldn't be a good situation for you because we manage everybody's capacity very carefully so that we can be at our best, and we have to manage my capacity also. And so, that is the reality. So I appreciate that question, but,
related to a previous question about rollover IRAs and Roth conversions, Form 8606 line 6 states, enter the value of all your traditional SEP and simple IRAs as of December 31st, 2021, plus any outstanding rollovers, subtract any repayments of qualified disaster distributions. So note that it does not say to include 401k balances.
Correct. So what this listener is referring to is that when you do a Roth conversion, if you have, your taxes, so you might, typically any amount you convert is going to be taxable income, right? But a lot of people have non-deductible contributions in their plan. And if you have a 401k plan, you don't include the assets on this formula. That's this formula that determines the pro rata portion of your Roth conversion that is actually taxable. So if you had all your money in a 401k and you had $10,000 in an IRA and you convert it all, right, then great, you're going to pay taxes on that $10,000. If you had, $100,000 in an IRA and half of it was non-deductible contributions and all the rest of your money was in a 401k, when you converted $10,000 to a Roth, $5,000 of it would be taxable and $5,000 would not be taxable. So it's a pro rata calculation based on your non-deductible contributions. So what that person is referring to, it really has to do with, if you have non-deductible contributions in your plan, and all the rest of your money can be in a 401k, then it can be a benefit to do those Roth conversions before you roll the money out of the 401k plan.
Is long-term care insurance a good option for those potential expenses, or are you better off with the life insurance policy with the long-term care option? I'm thinking the rider. The cost of long-term care insurance plans have really shot up in cost.
They sure have, haven't they? The last time I talked with a very, qualified agent that I trust about that, her perspective was we're seeing more and more people buy what are called the asset care type plans, life insurance that has a benefit that you can tap into if you need long-term care. And so, they don't offer as much typically in terms of benefits. The benefits aren't as rich, but of course they cost less. And so with insurance, it's always about what is the risk that you're trying to hedge, right? You are paying a premium or a set of assets to shift a risk to the insurance company rather than retaining that risk yourself. Without comparing the actual products and your situation, I don't know. But the real question isn't is one better or not. It's what is the risk that I'm covering, and is that an acceptable trade-off for getting that type of coverage?
In constructing your year-by-year withdrawal schedule for the various investment accounts, the Roth, tax-deferred, taxable, what do you consider in deciding which accounts to draw from when? It sounds like you make these decisions at the beginning for the entire drawdown period and then set account asset allocations accordingly.
So what we consider are primarily taxes, right? So we're looking at what would the tax impact be if we withdraw from this account versus that account. And we're including, any potential Roth conversions and so on in that. So it's really a matter of what's going to be the most tax efficient way to draw down. Now, every year that projection is revised and updated because things change. The tax rates are indexed to inflation. As we've seen, the RMD age changes. And so it's a back to my flight plan analogy, right? It's a general guideline, and we're building the first few rungs of that income ladder according to that plan, usually in a way that gives us the most flexibility. And then every year we're revising it. And so like anything, sometimes it does change. Sometimes we say, all right, well, because of this tax event, I need to take money out of this account instead of that account. And, we try to build the most flexibility as we can into the plan. But we're not building the portfolio for 30 years all based on the initial withdrawal plan. We're building it as we go, typically looking out about 5 to 10 years in advance.
You talked about having the spouse with the higher Social Security benefit claiming to start at age 70. When does the other spouse typically claim if they're the same age? Is it 62 or full retirement age or somewhere in between?
I don't know off the top of my head, and it would really depend on whether that other spouse had earnings of their own or not. So, if that other spouse had no earnings, for example, then they would be collecting a spousal benefit at their full retirement age. If they did have earnings of their own, then it would just depend whether they were collecting at 62 or at their full retirement age. Those would be the most common ones that we would see. Health could also play a factor. So if they were very healthy, then it's likely a full retirement age would or even age 70 would be the answer. And if they had some health conditions, then it's possible that they would be claiming even as early as 62.
Yeah. It's why we ask about it every single year. We talk about it every single year.
Yep.
Right. Is it regarding HSAs? Is it true that the savings in this account can be used for any kind of expenses, not medical, after a certain age, without paying penalty or taxes?
I don't think so. Do you know, Nancy?
Yeah, there's a point where you can just take withdrawals, but what you would do is you could kind of use it for anything. But if you have receipts from years past, however long ago, you can use those to justify withdrawals. But
Yeah,
off the top of my head, there's an age past which you have to do this.
Yeah, and
jump in.
Somebody says yes, you can take it out for any reason after 65, no 65, taxes. We'll double check that and follow up. Maybe I'm wrong, but I believe it was no penalty taxes. But I think if you take it out for non-healthcare reasons, there are still income taxes. That was my understanding.
Unless you can match it up with an old out of pocket. Oh, yeah. So you pay taxes after 65. Yes. If you don't have that. So yes.
Yeah, it's a matter, you can use it for other expenses. I believe they waive the penalty tax, but you still pay income taxes after a certain age. We'll look it up and we'll post it in the comments or send it out with a webinar. Yeah. But and you can save up all your receipts and expenses and then turn those all in and take a chunk out.
Yeah, at 65, you can take penalty-free distributions from the HSA for any reason. However, in order to be both tax-free and penalty-free, the distribution must be for a qualified medical expense. Withdrawals made for other purposes will be subject to ordinary income taxes.
Thank you. Much more clear than the way I said it. So thank you. Thank you. That was from one of our attendees that Nancy was reading, so we appreciate it.
All right, let me just see if there are just a few other questions. Dana, you're amazing that you keep going. As more individuals retire with Roth IRAs being a bigger portion of their portfolio, how do you think this will impact future tax rules and how retirees should think about their individual withdrawal strategies?
So it's interesting, one of the experts that we follow, Jeffrey Labine, I believe is his name. Did I get the last name right? Yes, okay, the Hammer. I know him by his nickname. So he did a whole presentation earlier in the year on the Secure Act 2.0, and it was interesting how many new provisions they are that favor the Roth. And so he said, it's the one thing politically right now that's easy to get through because it creates more tax revenue today, right? If we contribute to Roth, then we have to pay taxes on the earnings and they go in after tax. If we convert, we have to pay taxes today. So politically, people don't argue over it and people like it, right? Us out here, oh, tax-free, tax-free. So it's good. How will that impact tax rules going forward? Right now in the near term, right, it appears that more and more legislation is favoring the Roth because I believe it's easier to budget if we pay taxes today and kick those distributions down the road. Now I know, some people will say, oh no, they're just going to do a 180 later. We don't know. I can tell you right now, it looks like Roth and Roths are becoming, more and more Roth options are coming into favor.
Well, along those lines, someone is asking, one can convert some or all of a traditional 401k to a Roth 401k if the plan allows it, correct?
Yes. If your plan allows it, they're called in-plan Roth conversions, and yes, you can do that.
Yep, it's whether you should.
It's whether you should. If you're in your highest earning years, that may not make sense.
Yep. Someone asking, how do you, I'm assuming it's you because you're in caps, so how does Dana protect against sequence of return risk?
Well, Dana personally is still 100% equity. And so I am age 51 and I plan to build the first rung of my income ladder when I'm 55 or 56. So it'll depend on where the markets are at. If the year I'm 55, we have strong market returns, I will sell stocks and buy bonds. And they said not for her, for retirees. So for retirees, we do it by building out the bond ladder.
Oh,
the same thing I will do for myself. I'm just not there yet. Is what we will do, for our retirees, as we project out how much they're going to need to withdraw. And then for that part of the portfolio, we like to buy very safe investments. We also do look at annuities depending on the factor we call the coverage ratio. And so we look at all of that and say, all right, you can't eliminate sequence risk. So we see that by the slide that's still up, the squiggly yellow lines, right? Sequence risk is you retire into a prolonged period of poor market returns, below average. Well, there's nothing you can really do, but what you can do is mitigate the fact that you might have to liquidate investments like stocks during a significant bear market. And so what the bond ladder does is it says, all right, well, we know we're going to go through bear markets. We don't try to guess. They're going to happen. They're going to happen. They could happen the year you retire. How do we make sure that that doesn't derail your retirement plan? Well, if a CD or a bond matures that year, you have that cash to spend. You don't have to liquidate your stocks. And so it allows you to wait out that bear market and not be forced to liquidate during a downturn. I see a second question, what kind of bonds? And so, agencies, munis, treasury bills are the most common types. We typically use very low risk, high quality bonds because that piece of the portfolio is designed for safety. It's to make sure that those cash flows are available to you. And yes, we do outsource that type of work. We use our investment partner, Asset Dedication. So, their bond trader managed one of the largest bond funds in the country for a period of time. And so they are the ones that are actually buying and sourcing those bonds for us.
If people hold dividend paying stocks, do you advise against them and switch to dividend ETFs instead?
Not necessarily. I mean, it would depend on, one, how much embedded capital gains are in those stocks. If you already own them and they're not in an IRA, how much embedded capital gains are in them. So it might not make sense to sell them if you're going to have to pay a tremendous amount of capital gains. And two, what portion of your portfolio is it? So generally, you have something called concentrated security risk. You don't want a single asset to be more than 5% of your portfolio. And depending on which stock it is, there can just be an additional risk from holding that. So those are different factors that we look at. If we don't generally focus on dividend paying ETFs, we have a different type of portfolio strategy that we use. And so if it's in an IRA, it's easy to rearrange the portfolio, but if it's not in an IRA, there's a lot of factors that have to be considered.
Question on when to take Social Security. I have run a software program that shows the best option for us is for the higher wage earner to wait until 70, but the other spouse starts at 62. Is that what you see in working with clients? And I think we've
it depends. There is a free Social Security calculator. It's called Open Social Security by Mike Piper of the blog Oblivious Investor. And so he's a very reliable, fantastic resource. So if anybody wants to go run their own strategy for free, it's called Open Social Security, and it's a great tool to use.
Yep. Regarding annual Medicare means test, is this based on a couple's income if they're married filing joint?
Yes.
Do you work with federal employees under the FERS system and TSP?
We do have some employees under that system, yes.
Some
clients.
Is the annual spending on the, this goes back, Dana, to the example you were showing. Is the annual spending on the timeline increased each year by inflation?
Yes. And so in this example, we were using 3% inflation for most spending items. We were using 5% inflation on healthcare related items. And then we had vacation spending with no inflation built into it, which was intentional.
Would you speak about the concept of taxation smoothing with regard to paying taxes over one's lifetime?
Yeah, so that's exactly the process that we use. We call it, tax managed versions of the plan. You wouldn't want to pay, 28% tax rate one year and then 10% the next. So, we project out your tax rate each year and say, how do we fill up the years where your tax rate might be low by either realizing capital gains, if you'll need to realize those to consume some of the portfolio for living expenses, or by IRA withdrawals, or by Roth conversions. And the idea is that over your lifetime, by smoothing it out, you can pay less cumulative taxes than if you don't do that type of smoothing. And so that's really the goal, is that's back to our juicing. Like, how can we squeeze more money out of the plan by reducing your lifetime tax liability?
Yeah. Would you recommend against investing in the target year funds? Question. These are a mix of equities and bonds, so you don't have the capability of withdrawing the bond component in the early years of retirement.
So in absence of knowing what to do, I think the target date funds can be okay. I don't like them in retirement because of exactly what you just said. You can't just withdraw from the bond portion or only the stock portion. I also see people use them, like we'll see someone's 401k and they allocated, 10% to the 2035 fund, and then another 10% to the 2040 fund, and another percent to the 2045 fund. And that tells us instantly that they have no idea what these funds are or how they work. Which isn't a problem. It's understandable, right? It's confusing. So I don't mean that in a negative way. It's just a lot of people don't really understand how they are. They're designed to be a one fund solution. I think when you're accumulating, they can be, if you don't know what else to do, they can be a good option. Sometimes we will use them in deferred comp plans. So remember, in a deferred comp plan, I can't pick and choose what money comes out of which fund, right? They pro rata will liquidate the funds. So sometimes in the deferred comp plans, we'll say, well, that money's going to come out over this 5-year or 10-year time frame. So let's pick a target date fund that's right in the middle of that time frame. So there are some times where I think they're good options, but in general, I think there's better ways to do it.
How do you model the cost of moving to a continuing care community in a retirement plan? And in parentheses, high entry fee, but all in long-term care and living expenses, etc.
It's hard to model. Most of the time we do a more general analysis that looks at what would the cost be for 5 years of care in a full care facility. And if you have enough assets to cover that, then likely you're going to have enough to move into a continuing care community. If your home is going to be paid off at some point in retirement, usually that's the asset that could easily be just exchanged into a buy-in for a continuing care community. If someone really wants to model it out, we would be able to model out, here's the down payment and here's the monthly obligations. I have had clients go into continuing care communities, and it was, it usually happened 15 or 20 years into their plan. But it was never a problem. It would have been very difficult to model it out when we first did their plan. But as that situation arose, it was very easy to model it out and say, okay, here's how we're going to do that. Here's how we're going to get the funds to pay in, and here's when we're going to sell your house, and so on.
I have a 401k with both pre-tax and taxed dollars, with about 40,000 taxed. I will need cash for this year, but would it be a better idea for me to roll this over to a Roth and then draw out from the pre-tax 401k for spending dollars this year, or is it about a wash?
Oh, I don't know how old you are. I don't know how long you've had the Roth. There are some very specific rules on what qualifies as a tax-free withdrawal from Roths. And so I don't remember those rules off the top of my head. And so I don't know. I can say you can Google, like, what is a tax-free withdrawal? And, there could be some restrictions that would make rolling it over and just taking out of the Roth not work. In addition, I don't know anything about the rest of your income. Like, if your income's going to be really low for the year anyway, then it wouldn't make sense to take it out of the Roth. It would make sense to take it out of the pre-tax portion. So that is almost impossible to answer. If you just wrote back that you're 66, at least I know there's no penalty taxes that would apply. And so that's the only clear-cut part of that answer I could give you. If you've also had a Roth IRA for at least 5 years, and you could roll the Roth part into that Roth IRA, then I can tell you that those withdrawals would be tax-free. But I don't know if that makes sense, because it would depend on the rest of your tax return for the year.
Here's another Roth question. I'm 66 and did a Roth conversion in 2021, paying taxes on it that year. 2 years later, I withdrew the money from the Roth account before the Roth account had been established for 5 years. Am I going to have to pay a penalty on that withdrawal for not having been in an established Roth account for at least 5?
Goodness, see, back to those rules, I just don't know off the top of my head. I don't believe you're going to have to pay a penalty tax. I believe because you're over 59 and a half. So once you're over 59 and a half, there's no more penalty taxes that apply. It's really a matter of whether you would have to pay income tax on any of the earnings portion. And so that would be the question. And it's possible if there's earnings that are distributed, there's a set of ordering rules about what comes out first. So your basis, the amount you already paid tax on, would come out first, and then any interest earned would come out next. And if you hadn't had the Roth 5 years, it's possible you would be taxed just on the earnings portion of any withdrawal if there was an earnings portion.
OMG, you are great for doing this and taking our questions, but my head still hurts from all this info. A little less, however. Thank you so much.
Makes our heads hurt too.
I don't know if you're aware of this, Dana. You've been answering, fielding questions for an hour and change. So
well, we should probably wrap up then.
So I got nothing else going on tonight, so I'm fine. But I don't know if you wanna, how you're doing.
A few more, and then I'll be parched. Okay. Running out of water over here. I know I saw one that was said, what is my view on living off of dividends?
Yes, there have been a couple of those. Yes. What are your thoughts about that?
So with very high net worth households, I remember, a guy we did a plan for probably almost a decade ago. And I think, he managed his own investments, had, I believe it was about 8 to 10 million, somewhere in that range, and used a dividend strategy and had more income from his portfolio than he needed. And so, he liked that strategy and was comfortable. And I think that's fine. The challenge is there's times where dividends go down substantially. I saw it in 2008 and 2009. Companies and dividend paying stock funds cut their dividends in half. And so if you're living off that income and a year like that comes along, your cash flow goes down by half. And if you absolutely have to have that cash flow at the same time that the dividends dropped, the value of the stocks dropped because now they're not paying out as much dividends. And so if you were to have to liquidate, there's a lot of risk, kind of tail risk, that one of those events could significantly derail your portfolio. So we like strategies that make sure that there's not going to be any substantial changes in the amount of cash flow that's available to someone. And so, that is not just living off the interest and dividends. Some years you might be using principal, some years, you might be using realized capital gains. But we like strategies that say, hey, we want to know that this amount of cash flow is available so you can budget and have a stable lifestyle and not have your cash flow be going down by 25 or 50% in the case of some crazy event. So that's why we don't use it. But if you're managing your own investments, you get to decide what the risks are that you want to take and whether you're comfortable with those kind of risks.
Yeah, we talk about that a lot in Strategy 3. We go through the fact that there are different ways to get money out of a portfolio.
There are
a number of different ways.
And we don't, have a monopoly on it. It's just, if we are responsible for the outcome, there is only one way that we're going to do it. And so, that's how we look at it. If you're responsible for the outcome, you have numerous strategies that you can pull from. We have a fiduciary obligation to our clients, and the risk is tremendous. And so we look at all of the available strategies and we go, well, if we're going to be responsible, this is how we're going to do it. And we're not going to do it any other way.
Yep. Can you offset taxes on a Roth conversion by doing a large QCD?
No. So the QCD, the qualified charitable distribution, just means that portion of the IRA withdrawal doesn't show up in your adjusted gross income, but you don't also get a charitable deduction for it on your itemized deductions. You don't get to double dip. And so the answer is no.
I think that may be good. We got some questions that are similar to others that were answered. Someone said may need to fire up the margarita juicer after this webinar. Dana?
I may need to. These are the most questions, but we had over
So.
400 people registered for this webinar, and I didn't look to see how many actually were there when we started, but a lot. And so of course we've had lots of questions. You were all troopers, those of you still here, for hanging on.
Yep. I think that's somebody said let her go now. Yeah, and as always, and I know that you get to see these, but so many people just like to say, thank you, great webinar, you're a rock star, all those wonderful things that I know it's heartfelt.
Yes, we love it. And I see someone just posted, just wait until the questions for taxes and retirement. Oh boy. That's going to be a fun one. Well, thank you, everybody. Nancy, you are a rock star too.
It's always a pleasure. Always a pleasure.
So much easier to do this with you. So I really appreciate it.
Of course.
All right. Thanks, everybody. Good night.